Ladies and gentlemen of the crypto space, we're live on Wednesday, September 20th at 11:33 a.m. I'm playing around with earbuds today, so I don't have the bulky headset on, and you're welcome to let me know in the comments if it's not the clearest audio. I could switch to headphones if necessary. Don't be a giant man, baby. So much emotions in this space, so many folks with ultra short-term time horizons. Now, clearly, the audience I speak to on this channel is seasoned to a degree and at least is receptive to the things I've talked about over years at this point. And we're talking about the average actor that we see on crypto Twitter, the average actor that is not accustomed to long-term capital management and wanting to see that growth over a period of time, not looking for those instantaneous rewards, the instant gratification crowd, the folks that buy the AMC and the GameStop and they're looking for that 1000x Lambo mode. I mean, heck, this entire channel is built around cash flow, and it's been like that for a long time. And I like that. Look at me. I'm not the guy that's sitting around frantic. I'm not that technical analysis day trader. I am a long-term manager that's old and wants to sit back and relax. And then that's the name of the game. 2 seconds. Let me just text a colleague. Okay. So passive mode, long-term growth, the volatility and the principle of the portfolio is going to be crazy. We've known that. What do you think Bitcoin hodlers go through with their massive drawdowns, especially in years past? So that's what we are going to go through. That's what we are going through. And the differences are stark with regard to the cash flow capacity of these enterprise. And that's the biggest thing. That's the thing that's different this time is the identification of actual enterprise that is quantifiable in terms of traditional value assessment. And all of this is going according to plan. And I've said attributes of survivability, and that's what matters. And that's been the plan the entire time. While it would have been nice to capitalize a little bit more from top down, I am overwhelmingly satisfied with the performance of the portfolio all throughout the depreciation, the decreased liquidity occurring in 2022. Obviously, in 2023, we've had an increase in liquidity. Let's try and find Mike Howell's post this morning about liquidity conditions, and we could talk about that as well. How about this giant man baby picture? That's got to be one of the cutest photos. Oh, my goodness. Let's find it. Where's Mike Howell? Replied, didn't I? No. And it was earlier. Okay. All right. So let's pull up another one, actually. Let's pull up time horizons that matter and perspectives that actually matter going forward. This one. Look at those time horizons and looking into the future. These are basically, I think this is the CBO projections, more or less. They go even further out. Yeah, CBO, source, Congressional Budget Office, long-term budget outlook. So obviously, historically speaking, World War II came down, and we had that as hindsight of what actually occurred. So projections are just predictions, but how can things change? It doesn't make any sense. You know, there's no, we don't have the same conditions nearly as what occurred at the end of World War II. And it's just we're in a decreased liquidity state. Liquidity stabilized, obviously, in 2023, but it's not like the structural change to employment and consumption that occurred at the end of World War II. And all the productivity that went into the war effort all of a sudden evaporating into nothingness because the war ended. So the composition of the economy changed. And, you know, clearly heading into 2024, that's not the same thing at all. So I love these types of time frames going back to obviously 1793 on this chart. So these are the things to consider. So obviously according to the government, it's up only mode. That's it. That's all it is. You can't see it any other way. So the question is how to digest that in terms of something that's favorable to you from a capital management standpoint. It's up only mode. So the volatility is irrelevant. So what's pertinent is surviving yourself with regard to your capital and identifying assets that have the attribute of survivability. They survive into the future. Liquidity conditions will improve. They will grow into the future. Therefore, these markets are actually markets, and I define these markets as an emerging market. So, what is going to do well in an emerging market? What has occurred from 2020 until today? Obviously, the overtones of an emerging market and the base layer of an emerging market is financial infrastructure that facilitates the capacity to do transactions, the capacity to do settlement, the capacity to issue credit. Credit is the lifeblood of an economy. So obviously, a lot of folks that are like Bitcoin purists will talk about, currency regimes that increase supply, and in regards to credit. So if you cannot increase supply of circulating currency, credit is restrained. It is restricted, and that's why we have, the history that we do of total currency units of circulation being more stable prior to 1971. And then once supply increases elastically, uh, the amount of currency units is a manifestation of credit in the system. So it just basically grows until infinity and beyond. Um, I guess the point is no matter what a Bitcoin purist may argue about Bitcoin changing everything, credit is still credit, and credit will create more synthetic Bitcoin units. And that is what we're starting to see with regard to a foundation in DeFi since 2020. This capacity to issue credit, which grows the amount of units, currency units in circulation, whatever denomination you want, whether you want synthetic Bitcoin or synthetic dollars or synthetic euros or synthetic yuan or what have you. That is credit. Now, credit is not just for leverage and the gambling that you've seen with regard to the activity in crypto markets over the last years. Credit is actually what runs business. And credit is not necessarily degenerate. Credit is maybe where a company has accounts receivable and they're expected to be paid in the next 30 to 90 days, net 30, net 90, and they need that cash up front. So they borrow that from the bank, whatever agreement is there, whatever credit agreement. And obviously, when they get their accounts receivable, they're able to settle the credit periodically with the bank. So they have their OPEX. They can finance their operating expenses. And that's literally what credit allows. Now, whether you have a currency restricted financial regime or an elastic currency regime is irrelevant. The credit is required in order to finance almost every aspect of normal business operation. You need the credit because accounts receivable, you're a producer, you give the goods to a retailer to sell the goods. It takes a period of time for the retailer to sell the goods to receive capital, thus, net 30, when the retailer makes the money, they settle the bill with the producer. So obviously, in a world where there is no credit, that entirely changes the supply chain. It completely restricts growth. So the issue with the economy, in many regards, is credit. It's not even necessarily the currency. So the currency has obviously gotten very toxic. Toxic. That's another story. That's because the damn government takes on too much credit. Ooh. Okay, so time horizons, back to the original topic. The last 3 years have shown us infrastructure of basically an emerging market, which is an emerging market of emerging markets. It's outside the entire system, that's above the entire system. So there's a capacity to issue credit, there's a capacity to settle transactions in this emerging market, and you're able to access this market without intermediaries, without a sovereign intermediary. Every country, 195 countries on the planet, are able to interact with this emerging market directly without going through another sovereign as an intermediary. If you want to interact with the New York Stock Exchange, a stock on the New York Stock Exchange, and you're in Singapore, you got to go through United States rules and regulations. You can't just go directly to the New York Stock Exchange. But that is not the case with 100% of the things in the crypto markets. So what does that mean? That means the infrastructure here is extraordinary from an enterprise standpoint and an opportunity standpoint. So I'm looking from a 3 to 5 year time horizon in the short term. I'm looking all the way out to 2030. So let's not be giant man babies and expect these immediate returns and not be surprised by 2022 and the liquidity cycles that we see that are so much more well understood now as compared to our experience with these markets in the past. I mean, look at this chart. And then you go look at the dollar and you're like, oh, there's our crypto market cycles where every relatively novice actor in these markets is like, oh, the bull markets. No, the liquidity cycle. Oh, the Bitcoin halving cycle. That was the damn global liquidity cycle. There's excess cash on the sidelines. People put it to work. And they put it to work in markets that have less friction. And what did I say about this being an emerging market where every country can go directly to it? This is the market with the least friction in the planet. Thus, why it has the greatest upside when liquidity becomes available, which is what Raul talks about, where the crypto markets just go asymmetric in positive liquidity conditions, and US tech goes much less, but it still goes up significantly because it has the sovereign intermediary, which creates friction. Flows are inversely proportional to friction. As friction comes down, flows increase. Now, that's a natural, fundamental physical phenomena. Voltage is current times resistance. I've talked about that before. Look at the inverse correlation. This is a very interesting chart. I love the work of Mike Howell and team. Look at this in 2009. Look at developed markets, liquidity significantly improved, but emerging markets significantly declined. So obviously, developed markets carry more weight with regard to liquidity conditions as compared to emerging markets. But obviously, the decrease in liquidity conditions in emerging markets is going to mute the overall presentation of liquidity at a global level, even considering the increase in liquidity from developed markets, and especially in heading into 2011, where developed markets decreased in liquidity and emerging markets were rebounding. So notice the inverse correlation or relatively inverse correlation occurring all the way up until 2018. 2018 was the top. Oh, guess what? What was the top in crypto markets? The myopic perspective of the crypto bull market was the 2018. And then 2019, many of us know what happened because it was a double liquidity crunch in both emerging markets and in developed markets. And then developed markets just blew it out in 2020. But notice the damn correlation that's going on. That's quite fascinating. What does this mean? We may not have the liquidity flush, the flush, the whoosh of liquidity that we had in 2020. But look at the correlation in 2023. Emerging markets and developed markets moving in the same direction. That's absolutely fascinating. That could very well indicate we have a very nice upcoming bull market. Now, bear in mind, this is a leading indicator. Liquidity conditions shows you what's going to come with regard to asset prices, because liquidity conditions basically indicates how much potential currency can be in the system depending on interest rates, so on and so forth, and countless factors that influence a creditor's capacity to receive credit. So this is a very nice leading indicator that suggests we're on an upward trajectory heading into 2024. And then we could inspect more granularly in actual technical charts, specifically bond market price action and bond market volatility and how that affects currency market volatility, because currency market volatility basically influences international liquidity conditions, which is the orange line in this chart, the emerging markets. That's a pretty interesting start to the stream. Time horizon. Look at that CBO projection of debt. What do you think the liquidity conditions are going to be? It's going to be a horrible disparity between asset prices and wage growth. Hopefully, they keep consumer price inflation at bay. So if consumer price inflation is kept relatively stable and they don't mess around too much with interest rates, and in fact, I'm inclined to think my base case is they will have consumer price inflation under control to a degree using interest rates, and I expect higher highs and higher lows on interest rates, which presents a fiscal challenge. Well, Groman talks about fiscal dominance. This is we're entering an era of Congress and fiscal policy being more significant to what's going on with the economy and asset prices rather than monetary policy. The monetary policy should be able to control consumer price inflation to a degree. Now, that's very contrarian, maybe to like a Peter Schiff, who thinks consumer price inflation is just going to spiral out of control. I don't necessarily think that's the case, but we'll see. Obviously, we have the technical data with regard to consumer price inflation, so we shall see, but that's not my expectation. I expect it to be controlled to a degree, and that will achieve goals with regard to social civility. And that's very important. The society is stable, everyone's making a paycheck, they're struggling right now. Wages should go up over time, and we go back to that period where people fight for wages. Look at the strikes that are going on. Great. Wages go up over time. Consumer price inflation is relatively stable. That means society is relatively stable. But for Congress to keep doing what it's doing, the fiscal policy is going to get wild. The debt is going to get wild. Therefore, liquidity conditions are going to get wild. Therefore, asset prices are going to get wild and the disparity will continue. The rich will get richer and the poor, hopefully, will stabilize. If the Fed is able to control consumer price inflation effectively using monetary policy. Fiscal, another story, two separate systems. That's the degree. All right, so hopefully this is a good introduction. Obviously, we'll look at the three important sets of charts: bond market, move, and the currency markets to see where we are. And I'll look into anything you guys want me to. Trevor, love me some cash flow. Damn right. Tapsy looks like he could be sitting in a Lambo like this with what, the baby, or were we talking about what's going on with Ben and oh, good old Bit Boy. What an absolute disaster. The amount of people he hurt with the stories he told. I mean, look at the stories we tell, and then think of the stories that he tells with regard to the assets and the price action on those assets. Horrible, horrible content that he didn't understand. He doesn't understand money. He doesn't understand it. He's not qualified to be talking about the things he's talking about. It's not a game. What's the title of this damn stream or the description of the stream? Capital management is not a game. This is serious. It's professional. You need real data. You need real narratives. You need to follow people that actually understand these things. He literally understands nothing about it at all. So that's a very complicated thing that I don't want to dig into too much. Anyway, morning HG, Paul. I'm young and I don't have a lot of money. I would like to be a bit more experimental in DeFi. Uh, because I find it fun, but this makes my tax reporting more expensive than actual taxes owed. Thoughts? Yes, stop trading. Maybe 5 transactions a year. I know that's crazy. So significantly reduce the amount of transactions you do. In 2023, I mean, obviously my income from cash flow gets sold, but that's income. That's not a transaction. So that's very simple tax reporting. Um, Reduce your purchases and sales of positions. You should have extreme confidence in a position before taking it. Heading forward, obviously, we've all had our experiences in the past, but heading forward, we all have an opportunity to engage with markets differently. Find extreme confidence to own something and own it. And that's why the cash flow narrative, the dividend investor narrative, was quite appealing to me, and why I have become very uh, concrete in how I engage with markets. It is solid. This is my process. This is my routine. This is my strategies, my plan of action. This is my game. This is what I do. Find your process, find your sequence, your methodology for engaging with markets. And if you don't have a capacity to define that right now, that's the goal. Define your checklist. I do this, I do this, I do this. And rinse and repeat. And don't deviate from the methodology that you define, because over time you will become good at it, and over time you will become comfortable with it. And all we need is time, because look at this chart. This chart right here indicates all you need is time. Time does the work, so you don't have to. So what you need is a methodology that allows time to pass, and then anything that survives is going to do very well. So what survives is the critical attribute to assess. Hope that helps. Lucian, from your friends, P2P network, and don't mention it to anyone, especially a taxman, no tax advice. Well, tax is an interesting topic, and it's what kind of was talking about. Just simplify, do very almost no transactions. I think I've done 3 transactions in all of 2023, literally 3. Everything else was income, and it's all very simple to report. And in fact, nowadays I literally just use QuickBooks. No horse, no tail. The captain, with remarkable leadership and a strong sense of community, united the crew to achieve a grand greatness and see earning admiration far and wide. Well, it's not the most popular content. Obviously, I don't have so many Twitter followers, and it's even less on YouTube. But I'm extremely consistent at this point. It's the same story over and over again through a different lens and variation, so on and so forth, to hopefully convey the message of what I've achieved with regard to my methodology. And if I have a rigorous methodology that gives reference, that gives something to compare to, as all of you develop your own individualized methodologies, a subjective methodology. I define Bitcoin, Ethereum, and USDC, USDT, CRV, USD as cash. Bitcoin and Ethereum as cash? What does that even mean? But that's okay. That's my definition. That allows me to be comfortable and put the composition of my portfolio into a framework that allows me to be comfortable. So I know a lot of people that think of Bitcoin and Ethereum as investments, and that's okay. Define it for yourself and stick to it. Write down the rules, the rules that you believe in and want to adhere to. If that helps, you stick to your rules. I just saw Popsicle Finance is getting a facelift. You've been following this, all Captain Daniel is at again. Daniel has always done great work. So high opinion of all those pieces of software. High opinion of all the developers that developed, Abracadabra and Popsicle over the years. Time was a fiasco. Olympus mode. Everyone was forking the shit out of Olympus. So that was a complicated one, but that was the prevailing trend at the time. So we can neglect that from assessing the potential significance of Abracadabra and Popsicle. Still high opinion of those protocols. Um, in any regard, with regard to price action, with regard to vested interest, who owns it, it's out on the risk curve. It's not something I need to have exposure to. At this point, heading into the next cycle, my portfolio is just extremely concentrated and I just don't need exposure to it. Why? Because what conditions will Abracadabra and Popsicle do well in? High liquidity conditions. And what will Abracadabra offer you? Revenue based on the amount of credit that's extended to interested creditors. So I already have exposure to that. So I don't need additional exposure to that type of system. I already have exposure to that type of system. So if I added something like that to the portfolio, it would be completely redundant. And what have I said with regard to redundancy? It's type of diversification. And a successful portfolio that does well with regard to its how much it's worth, its value, ends up being more concentrated over the years. Sell the losers, buy the winners, and in the end, you don't need many assets to start a successful portfolio. Buffett always said if he just owned insurance, he would have made so much more money over the years. I, that was an interesting point he made. So even he was excessively diversified in hindsight. So I always found that quite fascinating. Time does all the work, and what survives and matters. X, Y, and Z. How much does it cost? How much is it paying? And how much is it likely to continue to exist in the future? And obviously, you want to be exposed to overall liquidity conditions, which that's exactly why the crypto space is so fascinating. XYZ and crypto market uh, uh, correlation to liquidity conditions is extraordinary. Asymmetric returns on an asset that is productive Y and is immutable Z, that's crazy. Making small $100 bets. That's all I have to invest right now. We'll buy cash flow. Yes, I've talked about this late. Portfolio size is critical to be respectful of. Cash flow is not for a small portfolio. Cash flow from a dividend investor mentality in equity markets, you're probably talking about, I mean, you need 5 to 10 mil to even consider cash flow in the equity markets. I mean, well, you get 5% uh, from you're not getting 5% from an equity because you might as well get it from bonds. You sell your damn equities and you buy the bonds, and now you have risk-free 5%. So if you're going for equities, I wouldn't deploy to an 8% equity right about now. It's just not enough. You need a risk premium that's significantly above risk-free in order to even consider exposure to equities for cash flow. So if you're exposing to, 10, 15, 20% uh, yield on an equity in this market, you really got to do your balance sheet inspection. You really got to understand who owns this shit. Are are they owning it just for capital gains? Because that's how irrational the market is. People own yielding equities for a capital gains perspective, and they're like, yeah, I'm going to get the yield also. So it's literally infinitely more complicated to engage with equity markets for a cash flow portfolio as compared to crypto markets. Why? Because of all the information. You need to inspect the balance sheet. You need to inspect the products and the cost of the products. You need to inspect what kind of returns they're making on the products. You need to inspect the human resources and how much OPEX is required to pay for the human resources, the board salary, the CEO salary. It's a freaking nightmare when you're talking about an immutable piece of software that eliminates real estate expense, human resource expense of an enterprise. Crypto significantly simplifies the equation for the original dividend investor methodology as compared to equity markets. This is the place to be for dividend investors. In fact, it's quite extraordinary, particularly because the yields are much higher. The volatility to the upside when liquidity improves is much higher. It's like, why the hell? they feel safer. They feel safer in that kind of volatile environment because equities sure as hell are going to be volatile, but they feel safer there. So, there was a post earlier. Maybe this will help. Yeah. If our society was moderately intelligent, this 13-second clip from 60 Minutes would have single handedly sent Bitcoin to infinity. He's right. I'm sure as hell not a Bitcoin purist, but this is absolutely the case. So that's the case as well with this dividend investor cash flow methodology. If if there was moderate intelligence, nobody would own any of these bullshit equities that raise capital by diluting shareholders and selling shares to finance operations. No, fuck that bullshit. It's an absolute shit investment. I've done dividend investing for years, going back to like 2014. And then 2016, I did more, but I ended up restructuring the equities portfolio away from dividend investing, more target 2030. But then 2020 came around and everything was like, oh, and this narrative that I tell you now was born. Um, Hope that helps. Paul, what to do if protocols are put in a position where they can't block VPNs and they surely cannot block onion routing. So that's at the protocol level. No conversation from the regulation and politicians is about Department of Justice action. So you just use an onion router or a VPN and just whatever. All these regulations are insane, and that's an entire topic unto itself. Raul's in the house, a pleasure. Austin, hey Noah, what are your thoughts on Stake Dow as a place for curve? Yeah, they've made a big U-turn, Stake Dow, over the years, especially compared to where they started, which is implied by the U-turn statement. I'm quite fond of the concept of liquid staking, especially for the smaller portfolio, 10, 20, 30, 50 grand, and you get in 20, 30, 40%, and you can make 20 grand a year on a 50 grand portfolio. That's pretty interesting. And then bull market hits, you get 5x on your money, 50 grand turns into 250 grand, and you may, in my opinion, is the 20% will stick around. Now you get 20% on a quarter mil. So that seems pretty interesting. Someone asked me the other day, what's a small portfolio? It's always going to be subjective, but you got to run the numbers. You got to run the numbers depending on your needs as an individual with regard to your real world expenses. If you want to make an extra $1,000 a year, how much do you need? And this is the XYZ equation. How much does it cost? How much is it paying? And obviously, how likely is it to continue into the future? So X and Y, you are buying cash flow. I want to buy my salary as an employee. How much would it cost? And you can look at the whole world like this. You can look at especially real estate. Property cost X amount. What is the likelihood? How much could I get rental? And what is the likelihood that that rental is going to be there? What kind of operating expenses do I have? Maintenance, so on and so forth. What are the odds of the tenant not being there that disrupts cash flow? And all of a sudden, the entire real estate market is down in 4% returns, which literally completely invalidates 100% of the real estate market from an investor standpoint, considering the risk-free rate of return of government bonds. 4% in real estate and all the goddamn pain in the ass that comes along with it, or you just buy a 2-year bond and call it a day and you're done and you just get paid. Okay, so that's why the interest rate equation changes everything going forward. And my expectation is significantly higher interest rates for many things across the board, because interest rates come back to the conversation about incentives and how you structure society. Incentives drive society. Salary is an incentive. It's an incentive regime, an incentive system. It's what convinces a person to actually perform work. There was no incentive, nothing happens. So that's when you're constructing a society, you're really thinking about an incentive regime, how to manage labor. Hope that helps. Also, I have a position in CVXCRV. What do you think about the consolidation into one curve derivative versus having multiple curve wrappers? Excess diversification will not achieve outperformance. It's not like one is going to outperform versus the other. The odds are they all just perform relatively equivalently, more or less the same. So don't, there is, you're diversifying with regard to risk, that one has an issue, one pegs, but they're not pegged. They're set by the market, set by pressures, buy pressure and sell pressure. So, and that is just what it is. So I don't see one more favorably than the other. I see them as all part of the recyclers that sterilize excess curve circulating supply. So when I see another one come online, I'm like, oh, that's nice. Base layer maxi. I just give a shit about the base layer. And when I see these derivatives and these, you know, down the line protocols come online, part of the federation, I'm like, I'm comforted because that's the whole point. That's my expectation in the coming years, in the next 3 to 5 years. If this is what has happened in 2020, since 2020 to 2023, what the hell do you think is going to happen between 2023 and 2026? How many protocols are going to come online? They're going to suck up excess supply. They're going to do exactly what Convex does, exactly what Staked Out does, exactly what Prisma does with regard to Convex. And then someone's going to recycle Prisma. And then the recyclers are going to get recyclers of the recyclers. And it goes on and on and on, applying incentives to convince market participants to engage with the market. Incentives create the flows, and the flows create fees. And all you have to do is attach to the base layer in that regard, in my opinion. That's my method for perceiving the market. Tape pusher, maybe you know, but your mic sounds lower quality today, just in case you're selecting the wrong one. No, I got earpods in. It's lower quality. I don't have the Steel Series headset on. So thank you for letting me know. I may consider going back to the Steel Series. I have another set of earbuds. I'm trying to just switch up the audio for my comfort, not, but I will obviously be considerate of the audience. Along the revolution, good morning, Cap. Much a pleasure, much a pleasure. Let's go a quick rundown of technicals. One more question, Halucian. Noah, how does Convex's new staking rewards mechanism change the value proposition for stake Convex versus vote lock Convex? Vote lock Convex is now separation of concerns with regard to stake Convex. Vote lock Convex only needs the revenue from vote rentals. Great. And now stake Convex gets all the revenue. So it's a significantly higher revenue. It'll get diluted. This is nice separation of concerns from a software architecture perspective, in my opinion, which carries over to a financial architecture perspective. This will just be favorable, in my opinion, for the composition of who's interested in the revenue derived from what source. I'm not interested in staking. I don't want a liquid position. I appreciate an illiquid position. That's exactly why I prefer the vote rental revenue. Many people, probably dependent a bit on portfolio size, want the liquid position so they can unstake and sell if need be. I prefer to get rid of that option and choice, and that brings me comfort. By eliminating options and choices, I have less things I could consider. And to me, that brings me freedom. So I appreciate that much. So bond market is being bid very nicely today, 0.69% on 10 years, 0.45% on 30, and even 0.67% on the 2 year. So this DXY move up to down to 104,796 is not based on today's bond market. It is based on move falling to 97.98 a couple of days ago. So the bond market pushes on move, and move is a forward-looking indicator on the currency market. So 9 days out, unless something significantly breaks or like commodities do some wicked shit, this monthly time-weighted average price looks quite inclined to hold as resistance from the monthly. We're in September, October, November, December. At the end of this month is Q4. So Q4, which is a 3-month period, is a very interesting period with regard to macroeconomic pressures, particularly how the currency markets are working. I want to see this obviously hold as resistance. I want to see one or two additional candles hold as resistance, and I want to see it directionally continue to the downside from here. Now, it would be interesting if Q4 ends with the time weighted average price on the monthly holding as resistance, and we push down into Q1 with the 50 on the monthly holding as support, and we see some chop around there. Obviously, I want to see this fall through, but this chart really needs years to play out, not just months, not even like a quarter, not just 3-month intervals. We're talking about years. So my expectation, and I've said it before, is like 60 on the DXY in 15 years. Talk about a time horizon, 15 years. So that's the chop. Now, here's an interesting thing about what the chop means. Look at those green circles. Those are your bull markets in the crypto space, the breach of significant moving averages to the downside, which is a significant increase in systemic liquidity internationally. More purchasing power in foreign currency means more liquidity, means anything liquid gets bid because there's excess currency, there's excess purchasing power. So if this was our crypto bull markets, imagine a directionality change at a secular level, like a significant structural change. We've been in a bull market for the dollar since 2008. These two blips, these are blips in prevailing directionality. These are the crypto bull markets. And we ripped to 113 on the DXY in December of 22. And it would be very interesting to see a structural change because that implies if this chart pattern has any significance, we could have 15 years of decreasing dollar value down to 60 on the DXY to be on this trend line of lower lows. And 15 years would mean, what is that, the super cycle that everyone talks about and puts the hyperbolic label on it? So that's what it could be. These bull markets for crypto were just insignificant little aberrations in the prevailing trend of dollar appreciation. But now, considering macroeconomics and geopolitics, the US might be in a position where they're like, all right, fine, the rest of the world needs the dollars. We're going to supply the dollars to FX markets. Otherwise, nobody's going to want to use the dollars anymore, considering the whole BRICS narrative. But that whole BRICS thing takes what? 10, 20, 30 years to play out. So they're going to want to retain the dollar being the desired asset. And to do that, they need to devalue the dollar such that foreign fiat doesn't become worthless. So a whole lot of geopolitical talk involved here, but I see very much the conditions that may warrant structural devaluation of the dollar. It's a relative game. Currency markets are a relative game. When I say devaluation of the dollar, I don't mean consumer price inflation and the prices of everything goes up. In fact, the prices of everything can come significantly down if you devalue the dollar and foreign currencies are more valuable. Foreign manufacturing can significantly ramp up as they want to be productive and they want to sell more goods and services to make more revenue. As there's more goods and services, that drives down the price of goods and services. So you could easily see a structural devaluation of the dollar as being a leading indicator for a significant reduction in consumer price inflation. Interesting causality to really understand the way the system works. It's not all, it's not what people make it out to be. Devalue the dollar. Oh, they're going to print more dollars. Yeah, but it could easily significantly bring down consumer price inflation. Now, they can't necessarily have it deflationary because what does that do to tax receipts? And what does that do to corporate earnings? And there's many more parts to the equation. Hope that helps. So the currency is interesting, but the bond volatility is the leading indicator. So this is another one. If we zoom out to the 6-month chart, the big move would come if you see bond volatility plummet below the 6-month time weighted average price. If you see the move indicator at 74 and breaching to the downside, and you know asset prices have yet to pop. If you line up these directionality changes, you're going to see significant price action in a favorable direction. This is a leading indicator of a leading indicator squared for asset price inflation. You want the asset price inflation. You want your prices of the shit you buy to go up. So that's why this chart is so meaningful. You see this chart come down, you're going to see the DXY come down for a very interesting mechanic. DXY comes down, international liquidity conditions improve, their currency is more valuable, it causes asset price inflation, and that's basically your bull market. DXY comes down, that's because of credit. Credit cycle from the Federal Reserve should play into that, but generally speaking, next year is going to be quite fascinating with regard to credit. And next year, at some point, interest rates, federal policy interest rates will come down, and the amount of on-the-run Treasury issuance required is going to be between $11.5 trillion to $13 trillion next year. A fresh on-the-run Treasuries that'll be bought. They'll be bought by who? In good part by the rest of the world. 2022, or was it 2022 and 2023? So the largest amount of foreign Treasury purchasing ever. The demand is through the roof because they know what's going to happen to collateral pricing as the bond market increases in price point on the long end. That's what fuels the credit expansion. Credit is a leading indicator of liquidity conditions. The liquidity improves, the asset prices improve. So next year is going to be like a perfect storm of improving liquidity conditions, from treasury issuance to the need for dollar devaluation, collusion to achieve dollar devaluation. So to cure, to alleviate to a degree the animosity towards the dollar and what it just did, 114 on the DXY, is crushing of the purchasing power of foreign fiat. So from a geopolitical perspective, they're probably going to respond in the way that I'm describing. Hope that helps. All right, I'm going to wrap it up for today. I got a lot of shit going on with regard to work. So, as always, I appreciate your time. 22 people in the stream, 24 likes. Wow, I appreciate all of you. That's awesome. Tell everyone to subscribe because, if you understand this stuff, one, you're going to do better, and you're going to do better because you're more comfortable, because you're not frantic. You're doing 3 transactions a year. 10, all right, you get crazy, you do 10. But you're doing less transactions and you realize that you really don't have to do much. And the thing is, you don't want to do much. Engage with the market the way you want to engage with the market in the future. In the future, I don't want to do anything. I want to go through an entire year without buying a thing. Just clicking a couple of buttons every week and getting paid. So in the meantime, I have to do work in order to set that up, but that's where I want to be in the future. So do things now to set up those conditions in the future. I wish you all a wonderful day. In the description is a link to the most rational community in the entire crypto space. Mostly a shout out to appreciate everyone that is figuring it out. And we help each other. And it means a lot to talk about these types of things. And then we could all do a little bit better. So I appreciate everyone in there. And I'm thinking about reopening free joining of the Discord, but that's complicated because I don't want a flood of not very focused, intelligent content. So that's a very complicated topic, but I'll think about things like that. I will catch you guys on Friday. Enjoy the rest of your week. Peace.